Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on Rolls-Royce Holdings. Can they get out of the COVID-19 hole that they're in? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both the short term and the long term. And as always, folks, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you'd like to hear daily stock reviews and recommendations. So let's get right into it. So Rolls-Royce is a United Kingdom-based engineering company. The company is focused on the power and propulsion systems. Its segments include Civil Aerospace, which is engaged in the development, manufacturing, marketing, and sales of commercial aero engines and aftermarket services. Defense Aerospace, which is engaged in the development, manufacture, marketing, and sales of military aero engines and aftermarket services, and caters to sectors including combat aircraft, trainer aircraft, and helicopters. Its power systems segment provides power solutions and complete lifecycle support under product and solution brand MTU systems. Now let's go ahead and look at some news of the company. So this came out from Barron's last week, and Rolls-Royce stock tumbled this week as jet engine maker warns of $2.7 billion cash outflow amid new COVID-19 strains. Now, Airbus is increasing production of planes at a slower rate, and airlines are cutting back on time planes are in the air equipped with Rolls-Royce engines at an estimated 55% of pre-pandemic levels. So that's pretty big. Now, enhanced restrictions are delaying the recovery of long-haul travel over the coming months compared with our prior expectations, placing further financial pressure on our customers and the wider aviation industry, all of which are impacting our cash flows in 2021, the group said in a statement to the London Stock Exchange. Rolls-Royce has already pledged to make disposals of around 2 billion British pounds by February next year. At the start of the COVID-19 pandemic, the group announced plans to cut 9,000 jobs as part of plans to save about 1.3 billion British pounds annually by 2022. This restructuring will be key enabler of their target to deliver at least 750 million British pounds of free cash flow, excluding disposals, as early as 2022, contingent on the expected recovery in engine flying hours, the group said on Tuesday. Now, looking ahead, the gloomy forecast from Rolls-Royce is a blow to investors, coming just a few weeks after the group revised its expectations for cash outflows in December from around $4 billion British pounds to $4.2 billion, or billion British pounds, I'm sorry. However, the company is well advanced with its cost-cutting program and liquidity, which currently stands at about 9 billion pounds. It isn't currently a worry, AJ Bell investment director Russ Mould said in a research note to clients last week, adding that should provide some comfort that it can weather the current storm, and I agree with that sentiment. Investors will be keeping a close eye on the state of the aviation industry and whether the second half of 2021 is realistic for a notable increase in the number of planes flying. I hope so. That matters for Rolls-Royce as its real money is made from repair and maintenance work rather than the sale of the engines themselves, and that requires planes to be in the sky, Mould added. Analysts at UBS said that domestic and inter-regional traffic is set to benefit the most in the near term, while long-haul and wide-body engines should recover in 2023 and remain below the 2019 levels until 2025. So basically, Rolls-Royce will have a few years to recover from this. That will only increase pressure on Rolls-Royce management to accelerate its plans to sell assets, further shore up its balance sheet as it prepares for more turbulence ahead. So it's definitely going to have a little bit of turbulence ahead. And about selling assets to drum up its balance sheet, let's look up another article over here. So Rolls-Royce, not that one. So Rolls-Royce, it sells Bergen engines to the TMH group for about 150 million euros. And now Rolls-Royce said that is selling the Bergen engines to the group for as part of its plan to become a simpler, more focused group. The British aircraft engine maker said that the sale follows a strategic review of the businesses announced in February 2020 and contributes towards its target to generate at least 2 billion pounds from disposables announced in August. So Rolls-Royce said it is selling the Bergen engines medium speed gas and diesel engines business to TMH International. which is a branch of the Russians TMH group. Now, the business that they had, it generated revenues around 239 million pounds in 2019, and it is expected to close second half of this year of 2021. All right, so they're shoring up some of their balance sheet, some of their assets. Let's look at the other news that's happened out there. Now, Rolls-Royce is way down by the 787 drag, and this came from Market Talk. Now, Boeing 787 quality issues could drain almost 700 million in cash this year from Rolls-Royce because of delivery delays, says Rob Stallard at Vertical Research. Rolls is one of the two engine suppliers alongside GE for the 787, and the company now expects the wide-body flying for its fleet to be 55% of the 2019 levels this year, down from the 70% forecasted provided last October. Analysts estimate Boeing may have as many as 70 Dreamliners parked awaiting inspection and any repairs, with production due to fall to 5 a month or lower this year. So that's definitely a drag on the company over the next year. But besides that, and do those news articles, let's look at some of the fundamentals of the company. The company has a market capitalization of around 10.54 billion. The projected revenues for 2020 will be around 11 billion pounds, with a negative 2.87 billion pounds. Even though the pandemic hurt the company's revenues in 2020 and potentially all the way to 2023, in 2023, the company is projected to have 13 billion British pounds in revenues, with a positive 443 million pounds in earnings. So that's great news that once we get our head around the pandemic, this company will get out of its hole that it's currently in. The concern that we should look at is its balance sheet, cash flow, and debt right now. So the debt level, it does have negative shareholder equity, which is more serious situation than a high debt level. It does have a sufficient cash runway, though, for more than 3 years based on its current free cash flow levels. Now, insider buying, the insiders have only bought more shares than they have sold in the past 3 months. So let me bring it back over here. So what did the analysts say on this one? Well, the analyst consensus right now is it's underperforming, with the average stock price target of 75 cents a share, with a high estimate of 75. They basically say it should just be around 75 cents a share. Now, going over one of the analyst reports, the Ford Equity Research Team has this one as a strong sell on the company as a result of their analysis on earning strength, relative valuation, and recent stock price movement. The company has generated a negative trend in earnings per share over the past 5 quarters. Yes, the pandemic hurt them really bad because the company lacks sufficient analyst estimate data. So there's not too many analysts out there actually estimating this company right now. They place greater weight on the historical earnings per share trend as a measure of the earning strength. Based on operating earning yield, the company is overvalued when compared to all the companies that they cover. Share price changes over the past year indicates that it will perform poorly over the near term. And the New Construction Research Report also has a sell recommendation. But what I don't think those research reports are really taking consideration is the future outlook of this company after the pandemic is over, and when the airlines are back in business and they're flying their engines, they're getting more revenues. So am I a buy, hold, or sell recommendation on Rolls-Royce? Here are my thoughts. Without the COVID-19 pandemic, Rolls-Royce would be soaring right now to the moon. Well, not literally to the moon, but it is still going on. More variants and even more vaccines are on the way. We're not out of the woods yet. That being said, Rolls-Royce recovery will take years. It's not going to be a over the night success. Now, looking at the company's fundamentals, we know that it can weather the storm over these next few years up into 2023 and beyond. The insiders believe in the company and have only bought shares over the past years. So looking at the fundamentals, strengthening balance sheet, cash flows, debt situation, selling off a few of the assets to strengthen itself, laying off a lot of people here and there to streamline their operations. I am a strong long-term bull on this stock, but be aware, I do not foresee any overnight success with this stock price over the next year. But 3 to 5 years projection, I see this trading above the $10 a share price in the long term. I love this company and I believe it will do great things in the years to come. But there might be a little bit of downside risk in the short term for it going from $1.37 a share right now, like almost maybe to $1.20 a share to $1.15 a share. What I would recommend is dollar cost averaging into the stock. So nibble it over the next 6 months to 8 months, and if you buy a lot of shares at $1.37 and it goes down to $1, you buy more. Well, you're in it at $1.15. This is a long-term play. This isn't a short-term play. This would be my long-term play. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you like to hear daily stock reviews and recommendations. Until the next stock update video later today, folks. Ciao.